Well, good afternoon and welcome to the ACC meeting. We're going to be discussing today on your screens 18 months of benefit changes in 60 minutes. Before we get to the mechanics of what we're doing, I'll introduce the speakers. I'm Jim Culbreth from the Charlotte office of Shumaker. I have my colleagues Heidi, Coughlin, and Emily Morrison from the Toledo office, also in the benefits group. On this, and then from TIAA locally, Cindy Bilbrough, who's in their in council office and handles the sort of questions we're talking about today. The point of today is just to cover some ground quickly that's been shifting for about a year and a half, but I want to toss it to Heidi and let her go through the mechanics of questions and so on. Heidi?
Good afternoon, everybody. Just to let you know, we are going to keep the PowerPoint muted. So if you have any questions, please feel free to submit them via chat or questions. And we will also open it up at the end where if you'd like to ask a question live, you may. Thanks.
Yeah, thank you for taking time out of your busy days for this. One of the problems you hit with benefits attorneys is that we like this material and we can fly over it at 30,000 feet or we can go at 500 feet. We love it. So if we do hit a point where we're glossing over something or drilling too deep in, we won't know. We can't wave your hand at us necessarily, but we'll know. Send us a question, send us a comment. We're trying to keep this focused on one thing, and I'll say this several times. These issues don't always come up directly into the council's office. They'll come up through HR, they'll come up through finance, maybe a combination. We're trying to cover this in a manner that shows where the sort of risk management side of it, what deadlines are involved, what the implications, what you could hear about, recognizing that everything here is not going to come across the plate of a council in-house. But we think most of it is going to be relevant for that, and we're trying to limit in that way. So we'll not cover a lot of things we could. It may sound like a warning, but it's not meant to be. There's a lot more in here. We're just going to touch the points we want to go. We'll pick it up with the slide one. In December 2019, basically employer-sponsored retirement community finally got a bill passed that had been in a gestation for a while. Secure Act passed in December 19. It started in the late Obama years, went through a massage period when Congress got to it and made a number of changes, and it came out and was signed into law in December of 19. Very big changes. Many of them have already occurred. Deadlines for changing plans are still coming up, but that was a groundbreaking. That was along the lines of the legislation we had after the Great Recession. It was pretty transformative. On top of that, and just coming right past that, were the acts related, and we'll just refer to them as the COVID-related acts. You see them listed there. It doesn't necessarily matter which is which, although there is some slight differences in there. But these came around, again, December 2019. We had the Secure Act. By March of 2020, we're in a different world. These are all responses to that. The interesting thing is that the both sets of changes came in both health and welfare plans and in retirement plans. So looking at some of the key changes in labor and employment and tax laws, you'll notice that in these situations the statute is often raced far ahead of the guidance. So we'll have situations we'll talk about where, and you may recall if you're had dealt with these issues, where we didn't know answers. We had the statute, but there were no regs. In the period of time the Secure Act regs might have been written, Congress was writing the COVID Change Act. So you have this period of time when Treasury is just trying to keep up and Congress is producing new laws. There are a number of things that have to be approved or documented. That's the result of all this kind of change that we had going on for really the last year and a half. If you look at the next slide, these are just the Secure Act changes that came out of retirement plans. Now, again, this may look familiar. We've had discussions about it, but there are some things that are still pending, and a number of these are still rattling around out there. For example, the age 72 as the new required beginning date for distributions, minimum distributions. That's a question that pops up in my practice fairly often. People want to know more about it. That's been there. People haven't changed their plans. They don't have to. They're operating under now. They're trying to sort of bridge the gap there. But this is just a short list, and we'll talk about these in detail in a moment. But this is the type of things that are just running into your retirement plans now that you should be aware of. And now we're going to talk, Emily, I think you're going to pick it up on retired minimum distributions.
Yes, hi everybody. So now we're going to dig into a little bit of what some of those specific changes were that Jim just mentioned under the Secure Act. We're not going to spend a whole lot of time on these, but wanted to make sure that we give you some background information. And as Jim mentioned, some of these may have been adopted administratively over time, but the amendments that are required for them have upcoming due dates. So we want to make sure that you're aware of all of those. And to the extent that those amendments have not been made, maybe you were waiting for all of the changes to happen so you could do one amendment to the plan rather than doing small amendments here and there over the course of the past few years. Some of those due dates are upcoming, so we want to make sure that you're aware of that. So what we're talking about here is they've increased the required minimum distribution age from 70.5 to 72. This 18-month extension really provides some relief to retirees who have other assets and want to be able to use those assets before they are required to tap into their tax-favored retirement plan benefits. So as I mentioned, the administrative compliance for this is June 2021, so that's right now. But the amendment is required by the last day of the plan year beginning on or after January 1, 2022. So to the extent that you haven't made those amendments yet with regard to this particular aspect of the Secure Act, make sure that that's on your to-do list.
Emily, just a question that we had hit, and I just want to see how it would play out across the group. Is that a required change? I think it is, but it's not really. It's one of those examples in my mind where the statute leads you to that conclusion. It could lead you to a different conclusion. Is that pretty much the take on it?
Yeah, I mean, I'm glad that you asked that question. Among the benefits attorneys that I've had this discussion with, our position is that it is a required change and that plans should be making, or employers should be making that change to their documents. There is space, I think, to argue that it is discretionary, but I think the situations where you would not want to make the amendment are really limited, because allowing the extension of this period really only benefits plan participants. So, you know, we're really recommending to employers that they implement this and make sure they make that amendment.
Yeah, it seems like this is one of those places where the statute doesn't have, sometimes it'll say may make the change, and sometimes it says shall, and this is one where I think it tends towards shall, but not necessarily. And I think that's sort of what makes this legislation that's brought about and implemented, even with a long time leading up to it, at the end of the day, this is the uncertain area that attorneys have to deal. So.
So one of the other changes that we saw as a result of the Secure Act is that they now say that long-term part-time employees who work at least 500 hours per year for 3 consecutive years now are eligible to make salary deferrals to plans. And right now, employers need to make sure that they are tracking those hours for their part-time employees, and to make sure that they're tracking their eligibility status. And by 2024, employers need to make sure that they are permitting those qualifying long-term part-time employees to have the opportunity to make those salary deferrals under the plans. So really, this might be a consideration for large employers who have a lot of part-time or seasonal workers, but it's something that employers need to be paying attention to.
Hi. Next is lifetime income disclosure. So you are required to provide 401k participants with benefit statements that include 2 illustrations, one for single life annuity and one for qualified joint and survivor annuities. And really, this could be a real wake-up call for people who have never seen their lump sums annuitized to show a lifetime annuity. So there are some assumptions that are in the current IFR. So payments would begin on the last day of the statement period. They selected age 67, which makes sense because most workers, that will be their Social Security full retirement age. If older, it would be their actual age. Once again, they would show this as a single life annuity and a qualified joint and survivor. For the illustration, they would show the spouse's equal age. However, there would be a little disclaimer language to show that, or to explain that that could be different depending on your spouse's age, if older or younger, and 100%, which would be the same monthly amount. They are using the 10-year CMT, which is the constant maturity treasury rate, and it's what insurance companies use to price immediate annuities. Also, they're using the gender neutral mortality table. So this model disclosure, what would happen if you have on your statement an illustration that falls short of what their actual payment would be? And it depends on the participant's age. So if they're over 50, you would write them a personal check of the difference, and under 50, you would Venmo them the amount. Who's not paying attention? So actually, the IFR says that no plan fiduciary or plan sponsor, as long as they use the assumptions and they use model language or substantially similar for the notice, that there will be a safe harbor and they will not be liable under ERISA. So the first statement that will be required will be the end of fourth quarter. So hopefully everyone at least is working with their 401k administrator to make sure that these lifetime income disclosure illustrations are close to ready to go. If not, if you haven't already provided them. The next thing, oh, go ahead.
No, I was going to say, this is a good example of making the process took so long to get Secure Act, I think, because of this is a very necessary piece. The income disclosures, people would get a lump sum balance. They look at go online and get a balance. Who knows what that would produce? So this requires a statement to be done. It does not require, as you know, that it be produced in Bitcoin. It is in dollars, so everybody understands at 67, they're just using dollars. But it does make a step in the direction of converting dollars into experience. People can look at a budget. And I think this came about, the requirement is one of the ones I recall they fought about because the insurance industry wanted one type. A lot of people wanted simplicity. Why would you have another requirement? This is one of the keepers, and I think it's one of the better ones they put in there. And it is very interesting that we had the fourth quarter statement coming up on us. So we'll see how this plays out. It may be a real revelation to people to have this detail, or it may be just something they look at and put it in the file or put it in the trash can, but we'll see. And this is a very well-intentioned thing. And it is going to be one that the failure to do it can get you in trouble. And that's the thing you note on this, or I do.
Yes, which you'll talk about in just on the next slide. Before that, we'll talk about penalty-free withdrawals for birth or adoption from a 401k plan, and where the lifetime income disclosure is required. This is voluntary. So the plan can offer early withdrawal with the penalty is not applied, the 10% penalty, if a participant within 1 year adopts or has a child. Here are the provisions. Both individuals can withdraw $5,000 from their account. Income tax is still applied, and the only adoptee that would not be eligible is that of your spouse. So they are not eligible. And one thing to note, it has to be after the adoption or birth is complete. So it can't be for payment of you could pay prior expenses, but the event has to happen. Therefore, you should require either a birth certificate or adoption papers with a TIN, their tax identification number, to document that. They are able to repay the amount. It can be repaid anytime. It can be a rollover either back to that plan or another eligible plan or IRA. It's, once again, it's voluntary. If you did adopt this, plans can be amended no sooner than the last day of the 2020 plan year. And now we will go to Jim for what he mentioned before with penalties.
Yeah, and this is where cost of failure goes up. This has always been penalties for not filing returns. If you look at the tax return, the Form 5500, registration statement, so on, the notice, change of notice status for the PBGC if you have a defined benefit pension plan. But what they did, when you pass the Secure Act, and in that you extend a year and a half the distribution period that you don't, before you have to start taking money out. That costs revenue to the federal government, state governments. That's a revenue loss. So one way you make it up is by adding increased penalties. What's noticeable here, among other things, is the size. It's a 10-fold increase. It goes up a lot. I mean, it's look at the Form 5500 per day to a maximum that's much higher. Again, $150,000 for failure to file puts a lot of pressure on that. This may not come across the desk of the council inside, but it will be something that flows up into risk management. It may be one of those issues. If you, I've seen it come up where I've been called outside by a general counsel, wondering if their record keeper, who the plan sponsor turns this over to make sure the 5500 is ready and so on. End of the day, somebody drops the ball, who pays the penalty? Well, the plan sponsor pays it. So it comes up as a matter of, what does your contract say? It matters more now because the penalties are higher. I don't see this being anything likely to change. It's probably not going to ever get smaller. It possibly could, but the probability of the revenue coming in now from this, and there's a lot recovered every year, millions of dollars in late penalties, and they are now more expensive. And you just don't want to miss these deadlines. From the point of view of somebody who's not intimately involved in the day-to-day, you just want to make certain that the people in your organization are aware of this increase, and that if they come in with questions, you may want to look at the service contracts or find out what happened. You can always negotiate. If you look at the $150,000 maximum penalty, that's a starting point. They won't tell you that, the IRS, but basically, if you have a reason that it happened other than defiance, you can bring that down. But it takes time, it takes effort on your part or outside counsel or your CPAs, somebody to give a reason. So you don't want to miss it. The cost of failure has gone up. Just bear that in mind. Now, if you have a plan with an automatic salary deferral increase, so you'd go up a percent or two a year, automatic, often paired with automatic enrollment. Now you can go to 15% for qualified automatic contribution arrangement plans. This amends the code in a way that plans may or may not. This is a discretionary. I do think that you'll see this come up more in plans that are up and kind of running well. Automatic increases communicated properly to the participants result in one of the reasons you have the Secure Act was so popular and through Congress was everybody wants there to be more retirement savings. This is the way to get there, but it is discretionary. Cindy, did you at TIAA, did you put this in or implement that, or has that already been in place? So you said that you pretty much had your plans up and running. Is this something
right?
That you
we did make some increases to our automatic deferrals, but we have not yet gone to the 15%. But it's definitely something that we plan to explore.
Yeah, I haven't seen anybody go to the max, but that may happen. It's not a 15% savings is great if you can get the participants to go that route, and you do it automatically and tell them about it, communicate with them. I think the statements, don't you believe that the statements at the end of the year will add to that? Somebody will see what the income coming out of their DC plan, defined contribution, their 401k plan. They'll see what it would mean in a stream of income. An automatic increase in savings might look more attractive. So there's a little bit of kind of interplay there. Anybody else have any comments on that? Okay, this is the next one. This is another aspect, and we'll kind of summarize Secure Act in just a second. One of the aspects they wanted was to make it easier. The perceived, one of the perceived reasons for not having everybody having a retirement plan was the complexity of it. Now, again, we know they're complex. Everybody on this panel knows how complex they are. But from the employer's point of view, plan sponsor's point of view, from the point of view of a general counsel advising a plan sponsor, a lot of this seems like there are so many moving parts. One of the things is the 5500, which has to be filed every year, and there's a penalty you saw before of a large penalty for failing to file or file late. But what they've permitted, instead of having, if you had 4 retirement plans, qualified retirement plans, 2 pensions and 2 401ks, for whatever reason, you've got different divisions, they work, you look at your discrimination tests, but you have 4 plans. You can combine defined contribution plans, individual account plans, that have the same trustee, named fiduciary, administrator, investment options, and plan years. And what that group of 5 points would be something where Vanguard or T. Rowe Price or somebody came in and offered a platform document and administration. You hire an investment manager to provide the investment options, and they go across the board. You've got a committee within the plan. You may be on that committee, but this permits, if you meet those 5 criteria at the bottom, you'll be able to file 1 annual report for several plans. The interesting thing that you'd want to watch is savings from your point of view, to not have to file, get these. There's no filing fee for them, but it's a lot less work if you can just get those things one time and file. I don't know how much this will matter, because a lot of companies do have plans, but they're separate. I mean, union plans are going to be different. They're not going to necessarily have the same fiduciaries, collectively bargained plans. But if you are dealing with defined contribution plans and they're out there in various forms for a year or 2, as you spin them off or bring them in, this will make things a little easier if they meet this criteria. I think it'll be well received, and it may be a question that comes up, but it certainly is something, if you're sitting on the retirement plan committee or somebody in the council office is there, that will be a big topic of discussion. And then the Secure Act. This is, again, what you've heard the last 20 minutes or so has just been the tip of the iceberg. There are a lot more changes. One of the things we as a group decided on was there's so many changes in there that were aimed in expanding the kind of simplicity movement they're going for, reducing administrative requirements across the board. They made a number of breaks that they provided to plans with fewer than 100 participants. So the IRS and the Treasury and Congress decided we'll give breaks to small employers. They defined it at 100. We didn't talk about it. Those are mostly not available, we think, to the members of the ACC. They could be, they're out there that we're talking about if you think you might qualify. But these are the reasons they did that. And I think the consensus in the professionals, accountants, advisors, TPAs, attorneys, is that it's working. I think we are seeing more activity in plans. It did simplify regulations. They did reduce costs. Sydney, once again, did it change anything appreciably in your job when these things went down? What you're doing in-house at TIAA?
It did not really, but of course, the lifetime income disclosure statements are something that we greatly support. So we were excited to see that included.
Yeah, well, I think it affects everybody differently. Just note these. We'll have a little summary at the very end of some things you have to do and consider, but just keep in mind that those areas were what they were looking for, Secure Act. They've done them. We're living with them. We're adopting them. That's where we are now. So we can now move into the COVID section. Put on your masks. Okay, things that were response to COVID-19. Remember here, we mentioned before, and I think we'll find as we go through these and break them out, COVID legislation was passed quickly. We noticed we had a problem nationally in March, and this was basically passed in March, and it was just right away. What got the attention largely were the SBA loans and some of the funds, the direct money to the economy. But these came around through really about 3 or 4 different acts. But they were written, the statutes were out before, well before there was real guidance. So we were, for the first months, struggling with questions that we'll get into in a moment that are affecting employers now. We didn't have guidance. Now we do. So you need to consider what you did before. If it's reasonable, there's reason to think there's no real problem. But this is one of the consequences of having a pandemic, a crisis. The sponsors included distributions related to the pandemic. They suspended in those required minimum distributions, which we saw were pushed from 70.5 to 72, were suspended last year. There are required and voluntary changes to flexible spending accounts. We'll talk about those. One issue, and I think Cindy said this, we'll talk about this more, but the COBRA subsidy, you said is a real impact for large employers trying to deal with it. Would you want to just give us a hint of what we're going to go on that one? That's a COBRA subsidy is two words, but it's pretty complicated. How would you describe that to the group?
Complicated in that, as you described before, there were certain requirements that even the deadlines passed for without any real guidance on how we were supposed to do those, which came out later. So just trying to reconcile what we had done, what we still needed to do, and making sure that we were getting out the notices and defining the group properly that was eligible.
Yeah, that's a time drain, and it has been for clients, so I can attest to that. Well, anyway, that's what we're going to talk about going forward from here. These are impacts still going on, more recent, but and some of them, in fact, are just being documented, but the things we dealt with that you need to be aware of as inside counsel. So, Emily?
Yeah, so the first thing from that list that Jim just mentioned that we're going to touch on is the coronavirus related distributions. So this was an option that employers could provide in their plans in response to COVID-19 to, there was a period of time there where people were really worried about being laid off or not having enough expenses to cover what we expected in 2020. And so these became available so that we could get money in the pockets of participants. So employers who didn't want to adopt these coronavirus related distributions don't have to amend their plans to permit them. But those that did need to make sure that their plans are amended by December 31st, 2022. So again, to the extent that any of you have plans where you're waiting to make sort of a larger omnibus amendment to capture all of these things, you want to keep that that date on your calendar and in your checklist. And one of the other things that's important about these is that participants who have made withdrawals for coronavirus related distributions are able to pay that money back over 3 years, beginning on the date that they received the distribution. So it's important for employers to communicate with their TPAs and to make sure that there are administrative functions in place in order to receive that money and have that allocated to their accounts. Another thing that we saw with these is that employers really didn't need to do much due diligence as far as whether or not someone qualified as a qualified individual to receive a coronavirus related distribution. The only thing that participants needed to do was to self-certify that they meet those requirements. And so it's really important for employers to make sure that they keep those records and that they have those self-certifications so that they know that they complied with the requirements when they made the distributions. And so that they have those records in place. So, and really this, the self-certification is an example of how, we were really trying to, and I say we, I mean, legislators were really trying to respond to the situation that the virus created as quickly as possible. And so it happened several times where they came out with legislation and said, okay, here's the legislation, this is what can happen, but we'll tell you about the details later. Yep. And that created some anxiety for employers and administrators because, okay, now we have people calling and asking questions about how they can receive these, and we wanted to make sure that that everyone was doing them in a way that's compliant. And so we got that guidance later about the self-certification. So that's really an example of how some of these options became available, and then we didn't learn the details about how to implement them until later.
That's a great example of having the statute written with every good intent, because it was trying to get money, open it up in retirement plans. But it did have this particular one seemed to have a lot of holes in it. And people would be creative, trying to figure if they were qualifying. And that's the qualifying individual. The statute used English, used words we all understand, but the meaning of them was missing to me. I mean, you could argue it any way you want to. The guidance came later, but for that period of time, we were scrambling. I'm wondering, Cindy, did you touch this one particularly when this was coming up as issues? I mean, you have to take some statements and later go back and document them in the way that's suggested in the notices. Is this something you hit?
We actually did decide to include this, but we had very minimal uptake just due to the requirements necessary to get it, because we did not have any COVID-related layoffs or anything like that. So to meet the qualifications, it wasn't likely at TIAA.
Yeah, just further on that, to the larger group, one of the requirements is that it had to be a layoff or something. You had people that had reductions in compensation, or the combined family compensation dropped because both parents went on some sort of reduced, but they weren't terminations, and you had to make calls. Now we know self-certification, they say they're in, you take that at face value, but for a while employers, as you noted, if you read it literally, it's very hard to get it. And so people trying to be generous were trying to find ways to get it in. People with money were trying to find a way to get it in. But the law was ambiguous. So this is a kind of one of the first flashpoints, I thought, in the COVID area, and it lingered. So.
Well, and I think it's an example also of how you mentioned with the Secure Act that they're trying to make things easier for plan administrators and for employers. And if they had asked employers to dig in and try and have evidence for all of this and collect all that evidence, and that would have been difficult for a number of reasons. And so this sort of showcases to me that the legislators really understood the need to simplify things overall as it relates to benefits plans, but particularly when we're all in the middle of a pandemic.
Sure, right. Been living this in real time, as we say. That was the whole nature of the summer last year.
Right.
Okay. Sorry. Yeah. We can move on. There we go.
Yep. So the next thing that I'm talking about is, closely related to the coronavirus related distributions, and there were loans. The qualifications to be a qualified individual to receive these was the same as the coronavirus related distributions. And here the loan amounts were increased in response to COVID-19, so people could take more money out of the loans from their plans. And loan repayments were also suspended for a year. So if somebody had a new loan or they had an existing loan in place, they could suspend those loan repayments, which really provided some relief in, of course, in the monthly budgeting for families who are struggling during this period, which was really nice. So if employers had employees take advantage of the increased loan amounts or the loan payment suspensions, it's really important to, make sure that there are administrative functions in place so that things are correctly reamortized and the participant understands the new repayment schedule, when that's going to begin for them, and what their payments are going to be. So loans that were eligible for these options have to have been made by September 22nd, 2020, and repayments began January 1st of this year for these loans.
That has to be documented by end of next year, right? That has to be in the plan as if you did that, right?
Right. So again, just like with some of these other things, they may have been implemented administratively. Decisions were made by the plan administrators, but to the extent that the amendment's not done yet, that needs to be in place by December 31st, 2022.
It seems, and Heidi, you may have hit this on since you work with the plan document side, it seems like employers are relying on, all size employers are relying on their service providers for documents, platform document, volume submit or whatever. And so speaking to a group of other attorneys, what's the word? Well, you've got a good record keeper out there. You've got again, a Vanguard, a T. Rowe Price, or Fidelity or something, but it's still the plan sponsor is the one that has to sign the document. If it comes in and doesn't get signed, if it doesn't come in because it was overlooked on the end of the document provider, it's still the plan sponsor's responsibility to get the thing adopted in, if you do loans or any of these other changes, by the deadline. So hitting where would it hit your council office there in-house? It may come in as a contract matter. Was it followed? It may come in as something that involves a penalty. We saw the increased penalty. So this is one of those places where it's already been there. The last loans are already done. They've been amortized, but now you got to get it in your document. And it's not so much that you have to remember the date, but just it's necessary, I think, to remind yourself in-house and outside council too, that there are deadlines that are still coming, even though the fire has gone out and we're left with just the smoke. It's still a concern.
Okay. Oh, Emily, I'm sorry. I thought I was, go ahead.
No, that's okay. So we're back to RMDs. So clearly required minimum distributions are on the mind of legislators. We saw that they made some changes to this with the Secure Act, and when coronavirus happened, they thought, okay, we got to be thinking about RMDs again. So somebody in there is really concerned about this and keeps bringing this up, which is good for us and good for plan participants. So, we know that the required minimum distributions were waived in 2020 as a response to the coronavirus. And this applies to 2019 required minimum distributions that were due by April 1st, 2020, and also to 2020 RMDs. So anything that was distributed, so to the extent that that they didn't get waived or they were distributed to participants, those are eligible for rollover. So I know we've seen that with some of our clients and their participants. And also, in discussing, I know it's been out there that there may be new legislation about this, and legislators are considering moving the RMD date again to perhaps age 75. So one of the themes that we see when legislators are thinking about this is they're thinking about ways that they can keep money in the plans for longer periods of time, and we may see more to come on that.
Okay, thank you. We'll shift into health plan changes. It's unbelievable to think that the earliest changes, the no cost sharing, the high deductible health plan, first dollar coverage for COVID-19 testing and telehealth have been in place for over a year now. We've had extended deadlines for people to make COBRA elections, to pay their COBRA premiums. As employers, you've had leniency in notifying plan participants with plan communications. We had terms like reasonably practical coming into play. We did receive notice the end of the outbreak period could be no longer than 1 year from the date eligible for relief. So it's interesting to think that if an employee was required to make a COBRA election on July 1st, 2020, then they would have until the end of this month to make that election. So it just seems like things are finally winding down. At least we do have an end, and we can go from there. One thing, as Jim said, I do look at a lot of plan documents, summary plan descriptions. One thing that came across so many times were clients' summary plan descriptions that either didn't have anything about how healthcare would be continued in event of a furlough, a temporary layoff, or a permanent layoff. And so just for those of you that did have good summary plan description language and you were able to administer healthcare continuation confidently good job, pat yourself on the back or someone else on the back that made that happen. And for those of you that didn't, just make sure that in the future that is clearly outlined and you have that in place for the future. These health plan changes are effective now through the duration of the public health emergency, which is announced every 90 days. So currently we're sitting at July 20th of 2021. However, it looks likely that it will go toward the end of the year. As far as flexible spending account relief, there were many opportunities that employers could take advantage of with unlimited carryover, extended grace periods, coupled with mid-year election change relief. So if someone either wanted to stop contributing or contribute more, depending on what had happened the past year, the problem is it was, as an employer, non-discrimination testing came into play, so that could have impacted your decision on whether you could offer this voluntary relief. And Cindy, I don't know if you wanted to speak to that.
Yes, so at least our company has tried to be as flexible as possible with employees with respect to dependent care FSAs, especially knowing that parents were receiving continuously changing messages about school, after school, summer camps, etc. And so, we really have tried to be as accommodating as possible. However, with respect to the limits, we are always very close to our non-discrimination testing limits. And so we are unlikely to make those changes.
Okay, and I'm sure that was the case and for other clients as well. Other voluntary relief was the spend down. So for people who terminated or just terminated participation, they could use those healthcare dollars later, and dependent care, and increase in the dependent care FSA limits, which if you couldn't implement these, there was also the tax credit as well. Once again, with the documents, this is kind of a theme that's running through this, but for when over-the-counter medicine without a prescription and menstrual products became reimbursable under the flexible spending account, just make sure when you that your employees are aware of this, your summary of material modifications, and when you look at the summary plan description, make sure you look in the excluded items just to ensure that those are removed from that list as they are eligible as of 1/1/2020. Now I know everyone's been waiting for this 100% COBRA subsidy slide. I think the first 3 dates say so much up there. So March 11th, the American Rescue Plan passed. April 1st, the effective date of the COBRA subsidy. And then May 18th. So think May 18th, the guidance was issued. I think that is a timeline for success. I don't know about you.
Well, it was also retroactive, right? It was passed March 11th. Looking back, wouldn't it look even further back? I mean, there are people out there who are affected before that.
Yes. So the notice, the guidance that was issued, 4 pages of guidance, 28 pages of Q&A. If anybody knows the exact amount of questions, it's the number 86, which I could make an idiom joke about that, but I'm just going to keep moving along. So for all of you who determined your assistance eligible individuals and may still be determining those folks, when you're looking at these, very difficult definitions of involuntary termination, kind of murky, you're assuming a retiree. That would be a voluntary termination, correct? Maybe not. If the facts and circumstance surrounding that say that that person retired only because they thought there was an indication of some sort that they might be if they did not retire, they would lose their job. So that may be an involuntary termination. So even now, if you're finished defining and indicating your AEIs, you may want to look back and look at the guidance a second time to make sure everyone was properly included. The attestations, that once again, you know, you talk about murky waters, people are certifying that they are, you know, they were involuntary terminated and are not eligible for other healthcare coverage. So there is just many factors going into this. So just once again, if you are still sending out cover letters with the election period and the availability, I would doubt that you're alone. I'm sure there are more clients who are still muddling through trying to keep up with this. Another thing that you will want to consider is your severance package. So if someone was offered a severance package, depending on when the COBRA continuation period began, so maybe you provided health insurance for the first 3 months. So then COBRA would start the following 3 months. That would affect when you, the subsidy would go into effect in addition to your credit. In addition, it doesn't include the amount the employer would have subsidized. So if, once again, you offered for 6 months that you paid their premium, that would not be a part of the repayment or the credit, I'm sorry. So I'm sure there are, if you, once again, if you have questions, feel free to submit them via chat or the question button, and we'll certainly get to them. Cindy, I didn't know if you wanted to interject anything here.
I mean, this has certainly been a major challenge and a significant part of how I've spent my time over the past couple of months. We feel like we're in a good place now, although I'm sure that the next step is going to be filing for the credits, and all of the questions will start coming in about that. So we're trying to take it one day at a time.
Okay, thank you. And the credit is claimed on IRS Form 941, and then there's another form, IRS Form 7200, just to let you know. So Jim, I'll pass it over to you for mental health parity.
Yeah, one of the things they've been trying to solidify, I think, in the benefits law side is making sure that mental health is covered as a benefit. And there's been movement afoot for a while on that. This is a different, well, I guess it is a quantification of what they're trying to get. How are you going to go about it? The non-quantitative treatment limits are applied, as you see here, to the processes, strategy, and evidentiary standards. The miracle of all of this is that you really, if you ask someone to compare the athleticism of, say, long distance running or swimming or tennis and baseball, they're both sports. These are all benefits. But what's required of each and how you would say, how do you compare the two is very hard. Here, you really are trying to develop a strategy that says we're going to, benefits in the same classification, limits, look at how much the employer has to do and how to cover. I think these are ones where we talked yesterday, and Cindy, I want to get your perspective on this particularly again, because you've been so involved in them. But the important thing is to have try to develop a standard and put it in place and communicate it rather than not approach it, because it is complicated. I mean, we talked about this some before. How involved is the council office and your expertise in that decision at TIAA?
So I think, as we discussed, a lot of the heavy lifting here is going to be done by the health plan, but it's a matter of staying on top of it at what's a very busy time. And so just even getting the bandwidth with the health plan, who's also trying to deal with all the COVID testing and the vaccination and all of those types of things right now, and get focus on this and making sure that you have what you need in place in case you're one of the first plans to be asked to prove that they're in compliance with this.
I guess from the point of view of in-house, this is merely something that needs to be on the mind of somebody in your organization. And it may come back to you. If you're on the benefits committee, it may be a job actually that you share the committee with other people. But the process in place and documenting that the deliberative process is your defense. So we didn't do it right, or we didn't do it. You have that in place. It may not be a perfect comparison, and you can always, not to say it couldn't be challenged, but by having one in place, you're 90% through the process. Just make sure your document provider is giving you those.
Correct.
Yeah. Okay. And other aspects of it, these are the questions you would ask. Have you performed and documented your analysis? And you notice that the analysis itself is something that will probably be given to you, but the fact is you need to have it there. Can you share it? And can you put it in your SBD, because you're supposed to tell people about it? You've got a participant request it within 30 days, they're supposed to have that. And so that's a bogey you're chasing now to have in place, because you start getting SPD requests. Summary plan descriptions are available to participants, and that has to be there. So that's a point that again, I think the best practice is just to make sure that you know it's supposed to be there and that there is some process that's being followed. Heidi? Yeah, the No Surprises Act really is this kind of surprise billing. There's a lot to it. The independent, basically the survey you're going to have somebody else dispute resolution handle is a piece that we see on it. But if you think of No Surprises Act, the ones that make the paper are where the person is presented with a large bill after having seen statements that are hard to sort out and that seem to be unfair, and you say, my gracious, how could that poor family have been given a $70,000 bill because they went to it out of network, or they did something that if they had known about it and they did an emergency. So a lot of these are aimed at emergency services, cannot require pre-authorizations for out-of-network emergency services. Common sense things, but it means your plan changes. It may mean ultimately, and I don't know how this works if you self-insure or fully insure, but either your cost of your stop-loss insurance or your fully insured plan may go up, because these are going to bring things in that aren't necessarily in the plan now. But the idea is to keep there being a person who's following it and still doesn't get where they're supposed to be. They're surprised by the bill that comes at the end. Very important to participants. High profile, as I mentioned, I've read 3 or 4 cases on the legal side where outrageous examples are given largely by the insurance company, but the employer is the one who's named in the newspaper article. And you want to avoid that. So this is something that's worth taking a look at. I'd go to the next slide. And this is one that we hit, and I think, Cynthia, you were talking about this. What do you do for incentives to get people to take a vaccine? The wellness programs themselves have always had restrictions of what you can offer people for, say, the paradigm is tobacco cessation. What do you do with this? I mean, how are you handling it there at TIAA?
At this point in time, we're only offering very minimal incentives through our wellness program. Essentially, we have a points-based program, and you do get points added for being vaccinated. We've supported vaccination incredibly as a company, but to this point in time, until we require anyone to report on campus, we've left it more or less to be just providing all sorts of resources to obtaining the vaccine and rewarding it in a fairly minimal way. But that was partially because we were waiting for the guidance that came out last week that clarified more closely how much and whether a company could even allow an incentive for a vaccination.
Yeah, and I think this is one we're going to be living with for a little while, because the vaccination process is winding down but not ending, and certainly the pandemic hasn't ended. It's still out there. And finally, a couple of final slides. Heidi, could you flip one over there? Yeah, these are ones. This is just a litany, and I think we'll do more than just put these out. These are all things that were affected by the COVID legislation. Some of them we talked about, some we haven't. There are, for example, disclosing broker compensation for the insurance. These are things that are going to help the administration of plans. They were thrown in, and I think at a good time, given time to digest them, we could have spent time going through them, but these are all other issues that are on the legal plate. These are requirements for plans that are out there that will come from your document providers, but ultimately may come back in as a legal question to your office. And I think the last slide is sort of a checklist, quick reference, required minimum dates. If you go through it, these are some of the things we've talked about, the FSA changes, subsidy, the mental health parity. Try to look at that as being the very, very short list. And then the due dates on the bottom of the slides will tell you when some of the material is due. I don't know if we have what time we have for questions. Do we have some questions we can put up?
I do not have any questions right now.
Well, that tells us several things, but I think I appreciate everybody being there. We all do. Send in, I guess, some questions later. You can call. We're available. You can talk to us. It is a good topic. It's a good topic to have now, and I appreciate everybody being out there on the panel and working through the presentation. Thank you so much for being there.
Hey, Jim, I can unmute if anyone would like to ask a question. They can. Does anyone have a question they'd like to ask? Okay, Jim, I think we're good.
Well, I can just add to the slide that we had before of the checklist, Heidi. I think that you had the red boxes for the required changes and green boxes for discretionary changes. So to the extent that any of you are going to be taking a look at these slides and this quick little checklist to go through and make sure that these things are done or that you have them on your to-do list, that's sort of the color coding there that can help you figure out if there are any holes in your plans and in your responses.
So thank you, everyone. Have a great afternoon.
Bye, everyone. Thanks.